This is Steve Memory at Iconic Wealth Management with an educational economic update for April 2018. In this month's video, I'll discuss some of the major headlines that influence markets in March. I'll also provide insights into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Markets in March continued February's volatility as major domestic indexes whipped back and forth between losses and gains. When the first quarter ended on March 29th, the Nasdaq was up 2.3% for the year, but the Dow and S&P posted losses for the quarter for the first time since 2015. Between January and March, the S&P 500 gained or lost at least 1% on 23 different trading days. That didn't happen a single time during the same period in 2017. Reflecting these fluctuations, the CBOE Volatility Index, or the VIX, a popular gauge of risk and fear in the markets, increased by 81%. The VIX hadn't increased this much since 2011. The Dow and S&P 500 entered a correction phase back on February 8th. That's defined as a drop of at least 10% from a most recent peak, and that peak was set on January 26th. You might say we're in a little bit of a slump. In fact, the S&P 500 index has gone 49 trading days, including Friday's drop of 572 points, without notching a new high. So why is this important? Well, since 1950, the average correction lasted for 61 trading days. So what happened in March to contribute to this volatility? Well, a lot. One critical development is that President Trump enacted tariffs on steel and aluminum imports from a number of countries. He also approved tariffs designed to punish China for stealing intellectual property. These actions created concerns about a trade war, and markets dropped in reaction. The resulting tit-for-tat responses between the U.S. and China has meant large day-to-day swings in the market. Friday morning, the new head of the White House National Economic Council, Larry Kudlow, said that serious talks between the U.S. and China have not really begun yet. Well, at least we know what's been said up to this point isn't serious. Though frankly, serious talks have given us an almost $300 billion increase in the trade deficit with China since the year 2000. Now, this is not to say that the economy is currently in a dangerous situation. The tariffs being discussed would not take effect until late May at the earliest, and much of what's going on may be really great negotiating, but robust growth clearly could be at risk if trade rhetoric heats up or interest rates are raised too aggressively. And in the meantime, volatility will have squeamish investors looking for safe havens. Now, drama in the tech world also affected stocks last month. In 2017, the tech industry outperformed other sectors throughout almost the entire year. By the end of March, however, unfavorable news about some key tech companies contributed to the sector dropping 4% for the month. During the month, we also received reports that housing starts missed expectations in February, and retail sales reports came in lower than expected as well. But March provided positive perspectives on the economy as well. For example, the latest reading of 2017's fourth quarter gross domestic product came in higher than anticipated. Between October and December 2017, the economy grew by a 2.9% annual rate. The latest data also showed that personal incomes are on the rise, and consumers have room to increase their spending even more. Companies added a below-consensus 103,000 jobs in March, well below the six-month trend of 207,000, and February's whopping reading of 326,000. The headline unemployment rate held steady at 4.1%. Same time, average hourly earnings increased at a 2.7% rate up from 2.6 a month ago. Now on March 21st to be specific, the Federal Reserve raised interest rates again and reinforced its perspective that the economy continues to grow stronger. In addition, last month marked the 9th anniversary of this market cycle's bottom. The milestone means that even in correction territory, we're still in the midst of the second longest bull market since World War II. So even when we experience more market volatility, like we did this past month, we can still say that we've come a long way in the past 9 years. As new developments arise and the markets fluctuate, please remember this. While volatility and circumstance may feel unpleasant, the movement of this market is actually very normal. That's it for this month's Economic Educational Update. Once again, this is Steve Memory with Iconic Wealth Management, signing off for the month of April 2018. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call. We're at 703-891-9518. We're happy to talk.